Listen to me. If you are thinking about retiring early, or if you just handed in your resignation at age 52, 55, or 60, I need you to sit down, pay close attention, and listen very carefully to what I am about to tell you. You worked hard. You saved your money. You did what you were supposed to do, and now you want your freedom. But here is the massive mistake so many of you are making. You think that when you stop working, your taxes just go away. You think, Susie, I don't have a paycheck anymore, so Uncle Sam can't touch me. Wrong. Dead wrong. In fact, if you retire early without a tax strategy, taxes will be the single biggest threat to your financial security. You could lose 20%, 30%, or even 40% of your nest egg to taxes and penalties that you never saw coming. And why? Because you didn't understand the rules of the game before you pulled the trigger. Let's talk about the fear that keeps so many early retirees up at 3 o'clock in the morning. You wake up panicking, thinking, how am I going to pay my bills until I reach age 59 and a half? How do I get cash out of my accounts without getting destroyed by the IRS? Will I run out of money because of taxes? I hear this fear every single day. And today, we are going to fix it. We are going to replace that fear with facts, strategy, and power. First, let's address the elephant in the room, the 59 and a half rule. Under standard IRS rules, if you take money out of a traditional 401k or a traditional IRA before you reach age 59 and a half, Uncle Sam hits you twice. First, you pay ordinary income tax on every single dollar you withdraw. Second, you get slapped with a 10% early withdrawal penalty tax. That means if you take out $50,000 to cover your living expenses, you might only walk away with $30,000 after taxes and penalties. That is financial suicide for an early retiree. So how do you avoid this? How do you access your own money early without handing it over to the IRS? Here is your first actionable takeaway, the rule of 55. If you leave your job, whether you retire, get laid off, or quit, in or after the calendar year you turn 55, you can start taking penalty-free withdrawals from the 401k or 403b of that specific employer. Did you hear what I just said? No 10% penalty. You will still pay regular income tax on the withdrawal, but that 10% penalty vanishes. Now, hear me clearly on this warning, do not roll that 401k into a traditional IRA if you want to use the rule of 55. The moment you roll that money into an IRA, the rule of 55 disappears, and you are trapped under the 59 and a half rule again until you reach 59 and a half. So many people ruin their early retirement because they blindly roll over their 401k without checking this first. Don't do it. What if you retired even earlier, say at 50 or 52? Then you need to know about IRS Rule 72T, also known as Substantially Equal Periodic Payments, SEPP. This rule allows you to take penalty-free distributions from an IRA or 401k at any age. But there is a huge catch. Once you start a 72T schedule, you must take those exact calculated payments every single year for 5 full years or until you turn 59 and a half, whichever is longer. You cannot stop, you cannot change the amount, and you cannot skip a year. If you mess up, the IRS backcharges you penalties on every dollar you pulled out. So 72T works, but only if you follow the rules to the exact letter. Now let's talk about the absolute best tool for early retirement tax planning, the 3 tax buckets. When you enter early retirement, you cannot have all your money sitting in one pre-tax account. You need balance. Bucket number 1, taxable accounts, your standard individual brokerage accounts or plain high-yield savings. Money pulled from regular savings has 0 income tax. Money pulled from taxable investments held longer than a year gets taxed at favorable long-term capital gains rates, which can literally be 0% if your taxable income stays below certain thresholds. Bucket number 2, tax-deferred accounts, traditional IRAs and 401(k)s. Every dollar pulled here counts as ordinary income. Bucket number 3, tax-free accounts, Roth IRAs. Every dollar you withdraw from your Roth IRA contributions is tax-free and penalty-free at any time, at any age. Why is this 3-bucket strategy so important? Because in early retirement, your earned income drops to zero. That means you are in the lowest income tax bracket of your entire life. This creates a golden opportunity for what we call a Roth Conversion Ladder. During those lower income early retirement years, you intentionally move money from your traditional IRA into a Roth IRA. You pay a small, controlled amount of income tax on that conversion now, while your tax bracket is low. Then, after that converted money sits in the Roth IRA for 5 years, you can withdraw the converted principal completely tax-free and penalty-free, even if you are under 59 and a half. Think about how powerful that is. You are controlling your tax rate instead of letting the IRS control you. Remember this, taxes in retirement are not about how much money you make, they are about how much income you report on your tax return. When you control your tax buckets, you control your taxable income. You protect your Social Security from being taxed later down the road, and you prevent massive Medicare premium surcharges, IRMA, when you turn 65. Do not wait until tax season to figure this out. Look at where your money is sitting right now. Talk to a tax professional who specializes in retirement distributions. Create a multi-year withdrawal plan that keeps your taxable income low, utilizes penalty exceptions legally, and fills up your Roth accounts while tax rates are on your side. Stand in your truth, take control of your money, and protect the retirement you worked your whole life to earn. You can do this.